Many economic events seem simple and limited in their effects on rates of growth, output, rates of inflation, and rates of unemployment. A housing market collapse in the U.S. in 2008 was seen, at first as just a collapse in prices in an overheated market. Sharp drops in crude oil prices in early 2015 and in 2019 were seen as a benefit to households that would reduce their driving costs and allow for higher expenditure in other areas, but caused economic distress for Alberta, an oil-producing province. Fiscal austerity aimed at achieving balanced government budgets in Europe seemed an obvious way to reduce high government debt to GDP ratios. But none of these initial judgments worked out. In each case, ignoring the complexity of the macroeconomy led to large errors in early forecasts and persistent, widespread problems with economic performance. An aggregate demand and aggregate supply model is the workhorse of macroeconomics. It integrates the effects of economic disturbances, economic decisions, relationships, and linkages that determine real GDP and the GDP deflator. Analyzing events like financial shocks, commodity price shocks, and government policy shifts using a full macroeconomic model provides a better understanding of their effects on rates of growth of GDP, rates of unemployment, and rates of inflation. In this chapter, we introduce a basic aggregate demand and supply model and use it to illustrate business cycle fluctuations in real output and prices. The economic theory and policy on which aggregate demand and supply are based are developed in the chapters that follow. Under normal conditions, the basic AD/AS model offers explanations of changes in economy-wide performance resulting from a disturbance or shock to just one sector of the economy. That might be a change in AD as a result of a change in business environment expenditure or exports when AS conditions are stable. Or it might be the effect of a change in AS as a result of a change in the wage rate or a change in technology that changes productivity when AD conditions are stable. Or it might be the effect of a change in government expenditure or monetary policy. In any of these cases, only one of either AD or AS shifts. The other does not. New finite equilibrium values on real GDP and the price level P are predicted by the new intersection of the curve that has shifted with one that remains unchanged. Large random shocks external to the economy and government policy responses complicate the use of basic AD/AS model. In Canada and other countries, business shutdowns and social distancing policies used to control the spread of COVID-19 epidemic are examples. The shutdowns reduce output, AS, and unemployment. The unemployment and losses of businesses and household income reduce AD even with substantial government income support and monetary expansion. AD and AS curves both shift to the left as the economy adjusts to a new equilibrium, real GDP and price level. But the size of the effects on national income and the prices are not easily determined. The last section of this chapter looks at a short-term estimates of the effects of COVID-19 policies on real Canadian GDP growth rates, unemployment rates, and inflation rates. The preceding sections examine economic performance before COVID-19. Section 5.1 Aggregate Demand and Aggregate Supply. The short run in macroeconomics is defined by assuming a specific set of conditions in the economy. These are 1. There are constant prices for factors of production, especially money wage rates for labor. 2. The supply of labor, the stock of capital, and the state of technology are fixed. In the short run, changes in output involve changes in the employment of labor and in the use of plant and equipment, but these changes may not be sustainable over longer time periods. Furthermore, because supplies of factor inputs and technology are fixed, there is no sustained growth in real GDP. We leave that topic for a later chapter. The national accounts we studied in Chapter 4 describe economic activity in terms of an accounting framework used to measure aggregate expenditures, outputs, and incomes. but the accounting framework simply measures what has happened in the recent past. It does not explain the level of economic activity and prices or the reasons for the changes in output and prices from time to time. For that, we need an analytical framework that looks at cause and effect. An aggregate demand and aggregate supply, or ADAS model, is such an analytical framework. It helps us understand the conditions that determine output and prices and changes in output and prices over time. The short-run ADAS models build on the National Accounts Framework. Aggregate demand is the relationship between aggregate expenditure on final goods and services and the general price level. Real GDP, by the expenditure approach, measures this expenditure at the price level given by the GDP deflator. Aggregate supply is the relationship between the output of goods and services produced by businesses and the general price level. Real GDP, by the economic income approach, measures this output and the corresponding real incomes. The price level is again the GDP deflator. National accounts tell us that, by definition, these measured outputs and incomes are equal. AD and AS functions describe expenditure plans, outputs, and prices using the National Accounts Framework. This distinction between measured and planned expenditure and output is important. Planned expenditure is the current output households and businesses would want to buy at different levels of income and price. Output is what businesses actually produce. Planned expenditure and the actual output produced by businesses may not be the same. Figure 5.1 gives us a first look at output, real income, and prices for a specific year using an aggregate demand and aggregate supply diagram. The price level, as measured by the GDP deflator, is measured on the vertical axis. Real output and income are measured on the horizontal axis. The point of intersection of the AD and AS lines show us that real output by the expenditure approach, Y0, is equal to the real income by the income approach at the price level P0, as required by national accounts. It also shows planned aggregate expenditures equal to the current output of goods and services. However, we need to explain the aggregate demand and aggregate supply relationships indicated by the slopes and positions of the AD and AS lines in the diagram before we use the model to study output and prices. Aggregate demand is planned aggregate expenditure on final goods and services at different price levels when all other conditions are constant. This relationship is examined in detail in the chapters that follow. A downward sloping AD curve means the relationship between planned aggregate expenditure and the general price level is negative. A higher price level reduces the expenditures planned by households, businesses, and residents of other countries. Lower price levels increase those expenditure plans. Aggregate supply is the output of final goods and services business produces at different price levels when other conditions are constant. The upward sloping AS curve in Figure 5.1 assumes that the relationship between the quantity of goods and services produced and the price level is positive. Prices and output rise or fall together. We will examine this relationship in more detail below and in later chapters. As we can see in the diagram, changes in either AD or AS would result in changes in the point of intersection of AD and AS and changes in equilibrium P and Y. But the important question is, what economic conditions and events determine the positions and slopes of AD and AS? The model is a tool for economic analysis that will only be useful when we know how it works and how to operate it. Aggregate demand and the market demand for an individual product are different. In our discussion of the market for an individual product in Chapter 3, demand is based on the assumption that incomes and prices of other products are constant. Then a rise in the price of the product makes the product more expensive relative to income and relative to other products. As a result, people buy less of the product. Alternatively, if price falls, people buy more. The link between the general price level and aggregate demand is different. We cannot assume constant incomes and prices of other products. In the aggregate economy, a rise in the price level raises the money incomes by an equal amount. A 10% rise in the general price level is also a 10% rise in its money incomes. Changes in the price level do not make goods and services either more or less affordable in terms of incomes. There is no direct price incentive to change aggregate expenditure. Furthermore, if prices of individual goods and services do not rise or fall in the same proportion as the general price level, the distribution of aggregate expenditure among goods and services may change without a change in aggregate expenditure. If, for example, the general price level is pushed up because oil and commodity prices rise, and expenditure on those products rises in the short run because there are no alternatives, expenditures on other goods and services fall. Aggregate expenditure is unchanged. As a result, we cannot explain the negative relationship between the general price level and aggregate expenditure as we would explain demand for an individual good or service. Nor can we simply add up all the demands for individual products and services to get aggregate demand. The assumptions of constant incomes and other product prices that underlie market demand do not hold in the aggregate. Different explanations are needed. Money and financial markets play key roles in the explanation of the price-quantity relationship in aggregate demand and the negative slope of AD as follows. Changes in the price level P change demand and supply conditions in financial markets. Higher prices raise interest rates and lower prices lower interest rates. Interest rates determine costs of credit and foreign exchange rates. Higher interest rates reduce expenditures on goods and services. Lower interest rates stimulate expenditure. The responsiveness of expenditures to changes in interest rates determines the extent of the change in expenditure Y as a result of a change in the price level P. Changes in expenditure then feed back to offset some of the changes in financial conditions. Chapters 8, 9, and 10 examine these financial markets and their effects on expenditure. The result is a negative relationship between the price level and aggregate expenditure and a negatively sloped AD curve. In Figure 5.2, the negatively sloped AD line shows planned aggregate expenditures at different price levels, on the assumption that the money supply and anything other than price that might affect expenditure plans are held constant. If the price level falls from P0 to P1, the movement along AD from A to B shows the negative relationship between planned aggregate expenditure and price. A rise in price would reduce planned expenditure as shown by moving up the AD curve. The position of the AD curve depends on all the conditions other than price that affect aggregate expenditure plans. We study these conditions in detail in later chapters 6 and 7. Aggregate supply, or AS, is the output of final goods and services businesses would produce at different price levels. The aggregate supply curve is based on the following key assumptions. 1. Prices of the factors of production, the money wage rate for labor in particular, are constant. 2. The stock of capital equipment, the buildings and equipment used in the production process, and the technology of production are constant. From national accounts, we know that the costs of production include labor costs, business and investment incomes, and depreciation. Market prices depend on these costs per unit of output, and the output and price setting decisions by producers. Aggregate supply is usually described as a positive relationship between quantities of goods and services businesses are willing to produce and prices. Higher outputs of final goods and services and higher prices go together. This relationship between aggregate output, costs, and prices reflects two different market conditions on the supply side. In some markets, particularly for those commodities and standardized products, Supply and demand in international markets establish price. Producers of those products are price takers. They decide how much labor and plant capacity to employ to produce based on market price. Broadly speaking, in these industries, costs per unit of output are increasing with increasing output. Employing more labor and plant capacity means expanding into less productive land and natural resource inputs. Mining gold or extracting bitumen from oil sands are good examples. A rise in price justifies expanding the output of higher cost mines and oil wells. However, many raw material markets are like this, including those for agricultural products, forestry products, base metals, and natural gas. When market price changes, these producers respond by changing their outputs. In other parts of the economy, producers are price setters. Major manufacturing and service industries like auto producers, banks, and wireless phone companies face market conditions that are different from those of commodity producers. They set prices based on costs of production and sales and profit targets, and supply the number of cars or bank services or cell phone accounts that are in demand at those prices. In these industries, costs per unit of output are constant over a wide range of current outputs. Money wage rates are fixed. The capacity to produce output is flexible and productivity is constant. If demand for their product or service increases, they can supply more by hiring more employees at existing wage rates and selling more output at existing prices. Industries like major manufacturing, retail services, financial services, hospitality services, and professional services are some examples. Output and changes in output are determined by demand. The upward-sloping aggregate supply curve in Figure 5.3 captures both market conditions to show the output producers are willing to produce and the price level. The aggregate supply curve is drawn based on assumptions that money wage rates and all other conditions except price that might affect output decisions are constant. As we will see in later chapters, money wage rates and productivity are the most important of these conditions. They determine the position of the AS curve. The slope of the AS curve depends on changes in cost per unit of output and price changes if aggregate output changes. As a result, it affects the structure of industry. In Canada, for example, Table 4.2 shows that about 70% of real GDP comes from service-producing industries. Consequently, we would expect a smaller positive slope in the AS curve than in Figure 5.3. In Figure 5.3, if price were P2, the AS curve shows that businesses would be willing to produce aggregate output Y2, which would generate an equal flow of real income. A rise in aggregate output from Y2 to Y3 would mean a rise in price to P3 to meet the increased costs and profits associated with output at this level. Changes in output or price, holding all other conditions constant, move the economy along the AS curve. Moving from point C to point D in the diagram shows this relationship. On the other hand, a change in any of the conditions assumed to be constant will shift the entire AS curve. A rise in money wage rates, W for example, would increase labor per cost per unit of output at every level of output. The AS curve would shift up vertically as prices rose in order to cover their increased unit labor costs. Section 5.2 Equilibrium output and potential output. The distinction between equilibrium output and potential output is very important to our study of the economy. In the short run, AD and AS determine equilibrium output. Potential output is determined by the size of the labor force, the stock of capital, and the state of technology. The general level of prices and short-run aggregate demand and supply conditions do not affect potential output. Short-run equilibrium real GDP is determined by AD and AS conditions. Fluctuations in real GDP and price are a result of short-run changes in economic conditions. To evaluate the economy's performance and understand how it behaves over time, we need a benchmark. Potential output is what the economy can produce on a sustained basis using the current labor force, capital, and technology without putting continuous upward pressure on the price level or the inflation rate. In the short run, the labor force, the capital stock, and technology are fixed by assumption. Potential output is the economy's output based on full employment of these inputs, but it is not the maximum output an economy can conceivably make. For short periods of time, we could make more by using labor for longer hours in factories for extra production shifts. Just as a marathon runner can sprint from time to time but cannot sustain the sprint over the whole race, the economy can operate for short time periods at levels of output above potential. Potential output is the output the economy can produce on a sustained basis. When the economy is at a potential output, every worker wanting a job at the equilibrium wage rate can find a job, and every machine that can profitably be used at the equilibrium cost for capital is in use. Thus, potential output includes an allowance for equilibrium unemployment, or structural unemployment, and some excess capacity. Some people who would work at higher wage rates do not want to work at the equilibrium wage rate. Moreover, in a constantly changing economy, some people are joining the labor force, others are leaving, and still others are temporarily between jobs. Today, Canadian potential output means an unemployment rate of about 6%. This is usually called the natural unemployment rate. Actual output can also fall below potential output. Workers who want jobs may be unemployed, and producers may have idle plant and equipment or excess capacity. The unemployment rate rises above the 6% full employment rate. A key issue in macroeconomics is the way differences between actual output and potential output affect unemployment rates, wage rates, and inflation rates. These effects are important to show the economy how it provides standard of living and the way it might adjust equilibrium output to potential output without policy intervention. Figure 5.4 illustrates potential real GDP with a vertical line. Changes in price from P0 to P1, for example, have no effect on YP. Changes in the supply of labor, the stock of capital, or the state of technology would increase potential output and shift the vertical YP line to the right or to the left. 5.3. Growth in potential output. Growth in the labor force and improvements in labor productivity increase the economy's potential output over time. Labor productivity grows as a result of advances in technology and knowledge coming from investments in capital equipment, education, and training. Figure 5.5 shows estimated growth rates for potential and actual real GDP each year in Canada over the period from 1990 to 2018. Potential GDP grew over this period, reflecting the underlying growth in labor force, the stock of capital, and improved technology. But annual growth rates were not constant, and in the period since 2000 have tended to decline. Part of this decline is attributed to lower rates of productivity growth in recent years as compared to earlier periods. Figure 5.5 shows how growth rates in actual GDP are more volatile relative to growth rates in potential output. The negative growth rates in 1991 and 2009 mark the recessions of those years. Fluctuations in AD and AS cause business cycles in real GDP and employment. Unemployment rises when output growth is less than the growth in potential output and falls when it is greater. 5.4. Business cycles and output gaps. In some years, GDP grows very rapidly, and in other years, it actually falls. Growth of potential GDP is also variable, but to a lesser degree. These up and down fluctuations in growth of real GDP are are described as business cycles in economic activity. Business cycles cause differences between actual and potential GDP. Output gaps measure these differences. In a short-run aggregate demand and supply model with a constant potential output, the gap equals y minus y of p. In an economy that grows over time, the output gap is usually measured relative to potential output. This recognizes that a gap of 10 million is a more serious matter in an economy with a potential output of 1,000 million than in an economy with a potential output of 5,000 million. Figure 5.6 plots the Bank of Canada's estimates of the differences between an actual and potential GDP for Canada, quarterly each year from 1992 to 2019, expressed as a percentage of potential GDP. When we compare growth in actual real GDP and potential GDP in Canada from 1990 to 2018 in Figure 5.5, we see an example of the business cycle caused by the 2008-2009 financial crisis. Real GDP declined in 2008 to less than the growth potential of GDP and turned negative in 2009. This was a recession. It created the negative output gap in Figure 5.6 that starts in the first quarter of 2009 and persists in the most recent data for the first quarter of 2019. Output gaps describe and measure the short-run economic conditions and indicate the strength or weakness of the economy's performance. High growth rates in the boom phase of the cycle create positive output gaps, which are called inflationary gaps, because they put upward pressure on costs and prices. Low or negative growth rates that result in negative output gaps and rising unemployment rate are called recessionary gaps. They put downward pressure on costs and prices. As economic conditions change over time, business cycle fluctuations move the economy through recessionary and inflationary gaps. However, you will notice in Figure 5.6 that recessionary gaps in Canada have been deeper and more persistent than inflationary gaps over the past 30 years. We can show output gaps in diagrams using the aggregate demand and supply curves and the potential output line introduced in Figures 5.1 and 5.4. Figure 5.7 provides an example. Panel A illustrates a recessionary gap. Panel B shows an inflationary gap. The AD and AS model provides a basic explanation of the differences we see between actual and real GDP and potential real GDP. Short-run AD and AS conditions determine equilibrium of real GDP, which may be either greater or less than potential GDP. Furthermore, the business cycles are the results of changes in the short-run AD and AS conditions. Introduction to the AD-AS model is an important first step in the study of the performance of the macroeconomy. But there are more questions. 1. How would the economy react to a persistent output gap? 2. Why do short-run AD and AS conditions change from time to time? The first question is considered in the remainder of this chapter. Chapter 6 starts on the second question. 5.5 Adjustments to output gaps. Potential output is real GDP when all markets are in equilibrium. Output gaps indicate disequilibrium in some markets. If we leave the short run and drop the assumption that factor prices are constant, we can ask, how does the economy react to persistent output gaps? The answer to this question depends in part on the flexibility of wage rates and prices, and in part on how planned expenditure responds to the flexibility in wage rates and prices. We also know from national accounts that labor costs are the largest part of factor costs of production, and labor costs per unit of output are the largest part of prices. If the labor market is not in equilibrium, which means unemployment rates not equal to the natural rate, this results in changes in money wage rates. Persistent output gaps will change wage rates and other factor prices and costs. Changes in costs will change prices, shifting the short-run AS curve. The economy may have an adjustment mechanism that tries to eliminate output gaps over time. This adjustment process assumes that the AD curve is not changed by the fall in wage rates that shifts the AS curve. There are good reasons for skepticism here. In a money economy, with debt and financial contracts denominated in nominal terms, a general fall in money incomes can cause financial distress, extensive insolvencies, and reductions in AD. As a result, economists generally agree that deflation, a persistent fall in the general price level, is contractionary, not expansionary, as the simple adjustment process suggests. This is reflected in the current concern that deflation might return to Japan and emerge in Europe as growth stagnates and inflation rates have fallen. (5.6) The role of macroeconomic policy. In Chapter 4, performance of the economy was evaluated based on the standard of living, measured as the real GDP per capita it provided. Recessionary gaps reduce the standard of living in the economy by reducing employment, real GDP, and per capita real GDP. Inflationary gaps reduce standards of living in more subtle ways. They push up the price level, raising the cost of living. But the price in the cost of living affects different people in different ways. Those on fixed money incomes suffer a reduction in their standards of living. People holding their wealth in fixed-price financial assets like bank deposits and bonds suffer a loss in their real wealth. On the other hand, inflation reduces the real value of debt, whether it is mortgage debt used to finance the purchase of a house, or a student loan used to finance education. The money repaid in the future has a lower purchasing power than the money borrowed. In these and other ways, the costs of inflation are distributed unevenly in the economy, making decisions about employment, household expenditure, and investment more difficult. We have also seen in Figure 5.6 that output gaps have been persistent in the Canadian economy, despite the possibility that flexible wages and prices might automatically eliminate gaps. These observations raise two questions. 1. Why are output gaps, especially recessionary gaps, persistent? 2. Can the government policy work to eliminate output gaps? To answer the first question, we need to think about two issues. The first is the flexibility or rigidity of wages and prices, both up and down. The second is the strong possibility of asymmetry between adjustment effects of absolute increases and absolute decreases in wages and prices. These are topics for later discussion. The important immediate policy question is, when wages and prices are sticky, should government wait for a self-adjustment process to work, accepting the costs of high unemployment or rising inflation that it produces? This was a very serious and widely debated question since 2008 in the face of growing international recessions as a consequence of serious government platform debt and continued international financial market uncertainty. Government has policies it can use to reduce or eliminate output gaps. In Chapter 7, we will examine fiscal policy, the government expenditures and tax policy that establish the government's budget and its effects on aggregate demand. Government can use its fiscal policy to change the AD curve and eliminate an output gap without waiting for the economy to adjust itself. Chapter 9 and 10 discuss monetary policy, actions by the monetary authorities designed to change aggregate demand and eliminate output gaps by changing interest rates, money supply, and the availability of credit. Both fiscal and monetary policy work to change aggregate demand and eliminate output gaps, which reduce the standard of living of the national economy provides for its citizens.